At 50, retirement is approaching, or for many of us, it may have already begun. This is the time we look forward to enjoying the fruits of our labor, but financial worries are not uncommon. Will social benefits and traditional savings be enough to ensure a comfortable life and maintain the wealth you've always aspired to? Proactively investing in passive income-generating assets is a smart solution, creating a steady cash flow without requiring significant daily effort. Even the legendary investor Warren Buffett emphasizes the importance of making your money work for you. This article will introduce 6 core asset types, along with effective strategies, to help you strengthen your personal finances and step confidently into the future of financial freedom. In the journey of building a solid personal financial plan for retirement, dividend stocks emerge as an attractive and time-tested option. This is not only a potential investment channel, but also an effective tool for generating passive cash flow, contributing to wealth and peace of mind when you are no longer working full-time. So, what are dividend stocks, and why are they important for those planning for the golden years of their lives, perhaps from now until 2025 and beyond? Essentially, dividend stocks are shares of publicly traded companies where, by owning them, you not only become a part owner of the business, but also share in a portion of the profits that the company generates. This portion of profit is called a dividend, typically paid periodically, quarterly, or annually as cash directly into the investor's account. Companies that choose to pay dividends are often businesses with a stable operating history, strong cash flow, and management committed to sharing business success with shareholders. This is a fundamental difference compared to growth stocks, where companies typically reinvest all profits into business expansion rather than distributing them to shareholders. The way dividend stocks generate passive income is very clear. You buy shares, hold them, and receive regular dividend payments. This money can be used to cover daily living expenses, reinvested to buy more shares, leveraging the power of compound interest, or simply serve as a reliable additional source of income. For those approaching or already in retirement, having a stable passive income stream from dividends helps reduce reliance on other income sources, such as social pensions or withdrawals from savings funds. The advantages of investing in dividend stocks are significant. Firstly, they offer a dual income stream. You receive cash from dividends and also have the potential to benefit from the appreciation of the stock's price over time, contributing to long-term wealth. Secondly, many leading dividend-paying companies, often referred to as dividend aristocrats or dividend kings in the U.S., have a history of continuous dividend growth for decades. This means your passive income stream has the potential to increase over time, helping to combat the effects of inflation, an important factor to consider when planning finances for many years of retirement. Thirdly, stocks are highly liquid, meaning you can easily buy and sell them on the stock market if you need to raise cash quickly. Finally, owning shares in reputable companies provides a certain sense of security, as you are investing in businesses that have proven their capabilities and sustainability. However, no form of investment is without risk. The value of stocks can fluctuate according to general market conditions or the specific business performance of the company. Although dividend-paying companies are often more stable, there is no guarantee that they will always maintain or increase their dividend levels. During difficult economic periods, some companies may be forced to cut or suspend dividend payments to conserve cash. Therefore, stock selection should be done carefully, based on thorough research into the company's financial situation, dividend payment history, and growth prospects. When applying this strategy to your retirement plan, especially when targeting goals for 2025 and beyond, there are a few points to keep in mind. Prioritize companies with strong fundamentals, healthy balance sheets, and an impressive and sustainable history of dividend payments and growth. Diversifying your investment portfolio is key. Don't put all your eggs in one basket. You might consider investing in exchange-traded funds, ETFs, specializing in dividend stocks, which allow you to own a diversified basket of stocks with a single transaction. Most importantly, have a long-term perspective. The market can be volatile in the short term, but with quality companies, long-term holding often yields good results for your personal finances, contributing to building a wealthy and comfortable future. Consider reinvesting dividends, DRIP, Dividend Reinvestment Plan, if you don't need the cash flow immediately, to increase the number of shares you hold and your future income potential. This is a smart approach to make your money work harder for you, even as you enjoy your precious retirement years. Continuing our exploration of passive income-generating assets for retirement planning, rental real estate emerges as a traditional yet still highly attractive option, especially for those seeking stability and long-term growth potential for their personal finances. Owning and renting out property can create a steady cash flow, significantly contributing to wealth and financial peace of mind as you enter your retirement period. The essence of investing in rental real estate is that you purchase a tangible asset, which could be a single-family home, a condominium unit, a multifamily home, or even commercial space, with the primary purpose of renting it out to others for their use. The passive income stream from this type of asset comes from the rental payments you receive monthly or as per the agreed-upon term from tenants. After deducting operating expenses such as property taxes, insurance, maintenance and repair costs, and potentially management fees if you hire a professional manager, the remainder is your net profit, the passive income flowing into your pocket. The advantages of owning rental real estate are diverse and appealing. First and foremost, it provides a relatively stable and predictable cash flow, provided you have good tenants and the property is managed effectively. This is a crucial factor for retirees who need a regular income to cover living expenses. Secondly, real estate has the potential to appreciate in value over time. History has shown that in many markets, property values tend to increase in the long run, helping to grow your overall wealth. This not only brings profit upon sale, but can also allow you to refinance to withdraw a portion of the appreciated value as cash if needed. Another benefit that cannot be overlooked is the ability to use financial leverage. You often don't need to pay 100% of the property's value in cash, but can borrow a significant portion from a bank, mortgage. If the rental cash flow is sufficient to cover mortgage payments and other expenses while still yielding a profit, then you are using other people's money to build your own assets. Furthermore, in the U.S., owners of rental properties often enjoy certain tax benefits, such as deductions from mortgage interest, property taxes, repair costs, and especially depreciation, which helps reduce the income tax burden. However, investing in rental real estate also comes with disadvantages and risks that need careful consideration. The initial capital investment is often quite large, including the down payment, closing costs, and potentially initial repair costs to make the property rent-ready. This can be a barrier for many people, especially those nearing retirement who want to preserve their cash. Managing property also requires time and effort, from finding and screening tenants, addressing repair issues, to handling unforeseen situations. If you are unwilling or unable to manage it yourself, you will have to pay a fee to a property management company, which will reduce your profits. Other risks include the possibility of the property being vacant for a period, vacancy, tenants not paying rent or damaging the property, and legal issues related to renting. Additionally, real estate is a less liquid asset compared to stocks. Selling a property can take a lot of time and incur costs. To apply rental real estate to your retirement strategy, especially if you are planning for 2025 or the following years, thorough research is paramount. Focus on locations with good rental potential, stable job markets, and attractive public amenities. Before deciding to invest, carefully calculate the projected cash flow, including all potential expenses, to ensure the property will yield a positive return. If you lack experience or time, hiring a professional property management company can be a wise decision. Although it will incur additional costs, it helps you truly achieve passive income. Remember that the goal is to create a stable income stream to support your retired life, not to create another full-time job. With proper preparation and management, rental real estate can be a solid pillar in building personal finances and achieving sustainable wealth. When it comes to investing in real estate to generate passive income for retirement planning, not everyone has the resources or desire to directly own and manage physical properties. Fortunately, there's a more flexible solution: real estate investment trusts, or REITs. This is an effective investment channel that allows you to access the lucrative real estate market without the headaches of being a landlord, while still aiming to strengthen personal finances and build wealth for the future. So, how do REITs work? Essentially, REITs are companies that own, operate, or finance various types of income-generating real estate. Their portfolios can be very diverse, including office buildings, shopping malls, apartment complexes, hotels, industrial warehouses, healthcare facilities, and even data centers or telecommunication towers. When you invest in a REIT, you are actually buying shares of that company, similar to buying shares of any other company listed on the stock market. What's special is that, by law in the U.S., REITs must distribute at least 90% of their taxable income to shareholders in the form of dividends. This very mechanism turns REITs into an attractive tool for generating passive cash flow. The passive income stream from REITs comes from the regular dividends you receive, typically quarterly. This dividend income originates from the profits the REIT earns from renting out the properties in its portfolio or from interest on mortgage loans it provides. For those preparing for retirement, this dividend source can become a significant part of their total income, helping to cover living expenses without needing to sell the underlying asset. One of the biggest advantages of investing in REITs is the ability to access the real estate market with a small amount of capital. Instead of having to spend hundreds of thousands or millions of dollars to buy a physical property, you can start investing in REITs with just a few hundred or a few $1,000s, depending on the share price of that REIT. This makes portfolio diversification much easier. You can own a piece of many different types of properties in various geographical locations simply by purchasing shares of one or a few REITs. Liquidity is also a significant advantage of REITs compared to physical real estate. REIT shares are publicly traded on stock exchanges, meaning you can buy or sell them quickly and easily during trading hours if you need to raise cash. This is in stark contrast to selling an actual property, which can take months and be costly. Furthermore, you don't have to worry about direct property management, finding tenants, collecting rent, repairs, maintenance. All these tasks are handled by the REIT's professional management team. Of course, they also come with certain disadvantages and risks. The value of REIT shares can be affected by general stock market fluctuations as well as factors specific to the real estate industry. Rising market interest rates can negatively impact REIT prices as their borrowing costs increase and other fixed income investment channels become more attractive. The quality of management and strategy of individual REITs also vary greatly, so performance can be uneven. The dividends you receive from REITs are often taxed as ordinary income, potentially at a higher tax rate than qualified dividends from regular stocks. When considering REITs for your retirement plan and financial goals for 2025 and beyond, thorough research is crucial. Learn about the type of real estate the REIT focuses on, e.g., REITs specializing in apartments, offices, industrial, or healthcare, its operating history, dividend payout ratio, and the fund's financial health. Diversification within your REIT portfolio itself is also a good idea. You might consider investing in ETFs that specialize in REITs, allowing you to own a diverse basket of different REITs. For those looking for a way to add a real estate component to their investment portfolio without the complexities of direct ownership, REITs offer an effective solution for generating passive cash flow streams and contributing to long-term wealth. In today's digital era, generating passive income is no longer limited to traditional tangible assets. Intellectual property and digital products are opening up unique investment opportunities, allowing you to transform your knowledge, skills, and creativity into automatic money-making machines, contributing to strengthening personal finances and aiming for wealth, especially as you plan for a comfortable retirement. So, what do intellectual property and digital products encompass? It could be a book you write, whether a traditional print book, an e-book, or an audiobook. It could also be an online course you meticulously develop, sharing your professional expertise. High-quality stock photos, unique video clips, or music you compose and license for use also fall into this category. Furthermore, developing useful mobile applications, utility software, or building a website or blog with valuable content that attracts stable traffic are typical examples. The common thread among these assets is that you only need to put in the effort to create them once, but they can generate cash flow for you multiple times thereafter. The outstanding advantage of investing time and effort into digital assets is that the initial creation cost can be relatively low if you do it yourself, especially compared to investing in real estate or stocks. Once the product is completed and launched on distribution platforms, it has the potential to reach a vast global audience of potential customers without incurring significant additional production costs per unit sold. This creates high profit margins and almost unlimited scalability. You create it once, but you can sell it thousands, even millions of times. However, creating high-quality digital products requires time, effort, creativity, and sometimes deep expertise. After the product is completed, you still need initial effort for marketing and promotion to attract users or customers. The market for digital products is also very competitive, and your ideas can be easily copied if you don't have appropriate intellectual property protection measures. For those preparing for retirement, developing intellectual property or digital products can be an excellent way to leverage the experience and knowledge accumulated throughout their careers. This can be an interesting side project that not only helps you stay active, but also has the potential to generate a significant passive income stream, supplementing your retirement funds and making life richer both materially and spiritually. In the journey of seeking sustainable passive income investment channels for retirement planning, owning a systemized business represents a pinnacle of wealth creation and financial freedom. This is not just about making money, but about building a machine capable of generating steady cash flow even when you are no longer directly involved in daily operations, an ideal goal for those who want to enjoy a comfortable retired life. A systemized business is one that has been built with processes, a workforce, and technology that allow it to operate smoothly and efficiently without the owner's constant intervention. Imagine a well-known franchise store where every process from product preparation, customer service, to inventory management is standardized. Or an e-commerce website with an automated system for order management, inventory, and customer care. On-demand service applications where technology connects service providers and users are also an example. The ultimate goal is for the business to be able to run without you needing to be present. The way passive income is generated from this type of asset is the net profit the business creates after deducting all operating expenses. Once the system is established and operating stably, you, as the owner, may only need to monitor key performance indicators and make strategic, high-level decisions, rather than worrying about detailed operational tasks. The biggest advantage of owning a systemized business is that the income potential is often much higher than other forms of passive investment. A successful business not only generates stable cash flow, but also appreciates in value over time, and you can sell it for a high price when you want to divest, significantly contributing to your personal finances. Building such a business also brings the satisfaction of creating value for society, jobs for others, and a legacy that can be left behind. However, this is also one of the most challenging paths to creating passive income. It requires significant initial capital investment, time, effort, management skills, and extensive experience. Building a truly automated system, finding and training a reliable workforce, and facing business risks are considerable challenges. Not every business can be easily fully systemized. For those planning for retirement, perhaps for 2025 or beyond, building or acquiring a systemized business is often a long-term goal that requires thorough preparation. One might start by building a small business, focusing on optimizing processes and gradually automating possible stages. Alternatively, if sufficient financial resources are available, acquiring a franchise business that already has an established system and reputable brand is also an option. Whichever path is chosen, the goal is to create a truly passive income source, allowing you to enjoy wealth and leisure time without being tied down by work. To achieve financial freedom in retirement, owning passive income-generating assets needs to be accompanied by a smart investment strategy. You need to clearly define your retirement goals and your risk tolerance. Diversifying your investment portfolio is a crucial principle to minimize risk, while also leveraging compound interest by reinvesting passive income. The investment strategy also needs to be flexible according to different life stages, prioritizing growth when young and shifting towards capital preservation and stable income when nearing or in retirement. Finally, don't forget to consider taxes and inflation, as well as continuously updating your knowledge to make wise investment decisions, aiming for a free and prosperous future. Through detailed analysis, we have explored 6 golden asset types capable of generating passive cash flow, a solid foundation for a comfortable and wealthy retirement plan. Building wealth and achieving financial freedom is a journey that requires perseverance and a smart investment strategy. Don't hesitate. Start taking action today. Research thoroughly, choose channels suitable for your personal finances, and build a solid roadmap for the future, perhaps starting as early as 2025, to make every dollar work effectively for you.